What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is April 13th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I not only want to take a look at the short-term as well as long-term perspective in crypto markets as we're still continuing to set significant higher lows and significant higher highs, but along with that, I want to talk about the continued developing macro environment with all that's going on with COVID-19 and how this is going to affect our longer-term outlook for the economy going forward. Again, a lot of things to consider here, a very big set of different things going on here, guys. So we're going to dive through all of it throughout the video. So I recommend you stay tuned right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DATADASH. Alrighty, so let's go ahead and dive into cryptocurrency markets. Over the last 24 hours, we've had a bit of a dip here in Bitcoin and most cryptocurrencies with a very few outliers in the green. Most of them down in negative territory. Nothing too significant though. More of a trend over the last 7 days as we have a general pullback against Bitcoin. However, a few outliers, one of the big ones being Chainlink here. Chainlink really killing it over the last few days, and we'll take a look at some altcoins here in just a moment. But I want to take a look first at Bitcoin, take a look at the short term, right? No need for TA here in the sense of using excessive amount of indicators here. We know that a lot of the broader indexes, for example, like the ScalpX index for the Fear and Greed index, is currently significantly low, meaning that Bitcoin is likely underbought, considering a lot of measures such as volatility, etc. But along with that, the major thing we look for here are higher lows and higher highs. Now, the momentum of these lows and these highs are starting to slow off a little bit. So in this case, I think we're getting a bit of a correction here in the short term, but most of the damage I think that's been dealt is probably going to be the bulk of it in this case, meaning I don't think we're going to pull down much lower. I don't see us really going down below 6,500. I think that this is the significant low here that we set. After a period of around a week of pullback, this is what's happened in most cases. We stagnate for a couple of days. We pull down for about 2 or 3 significant sell side days, and then we continue onward. Now again, my thesis here is still remain the same. I think that over the next coming weeks, we are going to continue forward, and we're going to come within the line of resistance here that we've seen. I'll go ahead and actually pull out the Bitstamp chart here so you guys can see that. We can see here that I have a general line here that I believe, again, we're going to continue charging forward somewhere towards 8,000 to 9,000 here, somewhere in this upper band here near the previous highs. And in this case, we're going to come back down after the halving event in this case, and then set a significant higher low here. Right? Again, not coming down to this line of support that we've historically held onto, signaling that bulls are putting in the pressure on price, that the demand in this case is starting to outweigh the supply. And again, the halving event is going to cause a stagnant or kind of a longer term supply shock on Bitcoin. It's not going to happen overnight, and that's why we tend to get the correction. As there's hype going into the halving event, Bitcoin comes back down to fair value, the demand shift starts to outweigh over supply, and then therefore we eventually break the line here and kick off the cycle in late 2020 and eventually get back to 20,000 and hopefully to our target range at the peak of the cycle in late 2022. $100,000. That's at least our target as of now. And I'll let you guys know if that changes. But as of now, that's the general kind of target we have. I'm not bearish here in the short term. Price doesn't really concern me. A 2 or 3% drop over a 24-hour period sounds pretty good compared to what we had a couple of weeks ago. So again, setting significant higher lows here. Recovered a lot of these losses, guys. Feeling really good here about price. Right. So this is the, again, shorter term view here over the next coming months. Right. Longer term, still looking at 100K. Now I want to take a look here, jump here to the daily, take a look here at some of our altcoin plays. Chainlink, absolutely killing it here, getting good volume here in the sense of trading volume here for its Tether pair. And then on the BTC pair, relatively decent volume. But you can see here in the sense of its Bitcoin pair, good substantial volume. Price is coming up here, getting back to the range we were at beforehand back in March. Now again, this is a range here again. Why I would have no doubt we'll probably see a red day or two here. But again, at the end of the day, we've come back in. The trend is still strong here for Chainlink, showing a lot of strength here. Just again, focusing in on the chart, getting back to this previous range here. If we close above here, this will be a new all-time weekly close. So again, I look at these longer term time frames. I look at the significant higher lows, the technical patterns that this thing has been building up for months. And even though we did have a nice severe pullback in the market, we've rebounded pretty much 4 weeks of downturn in 1 week. So it's really good to see that kind of strength coming back in. And I have no doubt Chainlink can continue that for the longer term trend. And this plays into a larger discussion here. I mean, there's Kyber Network, there's REN, there's also Sol basic attention token that we've talked about. But I want to go ahead here and just take a look at the broader trend here for altcoins, right? This is altcoin dominance basically flipped. So, or sorry, it's Bitcoin dominance flipped. So we're actually getting a picture of the actual percentage for altcoin dominance. And we've been setting significantly higher lows, breaking away from this line of support. Now, again, I want to emphasize this, guys. You can look at a ton of indicators. You can do all kinds of stuff to determine what the market's, saying or what price is telling you. The best thing you can do is just look at price and think about what this psychologically means when altcoin dominance is increasing like this. This means that people are buying into altcoins at higher premiums in this case. They're paying higher prices. Altcoins are likely setting higher lows, at least compared to Bitcoin. And this means that people are preparing in this case. They're building positions here for a much broader trend reversal in this case, where risk-taking is increasing. And that's basically an anticipation for the next cycle. You can see here that they're not even in a consecutive line here. They're starting to actually pick up momentum in the sense of altcoin dominance in this case. And it's looking like buyers are really setting aside that pressure to where eventually we're going to break this line of resistance that's been held ever since back in January 2018. And we're going to continue on to the next cycle. Is it going to be 2015 through 2017 kind of price action? No, there's just not that kind of percentage gain and kind of room for altcoin dominance to grow at the same rate it did before. But we're still going to have a lot of outliers that really do well. And I think it's going to be a lot of fundamental plays that really lead the market. Price is telling me this, guys. It's, again, not me being biased. The fundamentals are really exciting if you're taking a look at anything in the DeFi space or the enterprise Ethereum space. A lot of interesting technologies. And then along with that as well, you've got what's going on here in the sense of market dominance here. So, again, keep an eye on this. Very important stuff here. Also, consistent support with previous resistance here, and also previous resistance and support in the past. I'll go ahead and keep that zoom there so you guys can see it, right? This level here was very significant, and the rebound that we got here speaks to the trend reversal here that we're likely going to see, okay? So again, Chainlink, a lot of those players leading the way here, but there's a lot of other altcoins as well. In the sense of crypto news, guys, there's not too much developments. There's one thing I want to talk about here, which is that EU lawmakers want to create a new regulatory or new regulator body for cryptocurrencies. This to me is really interesting, as I've had a lot of people talking to me personally discussing about the continued developments with the ECB talking about a central bank digital currency. Now, I think, again, at the end of the day, guys, I have a lot of you who will respond like, this is the classic response I'll get from a lot of people. I would never use a central bank digital currency, and along with that, who gives the right for EU regulators to even step in and regulate crypto markets? Again, guys, at the end of the day, I don't really per se care about what the EU, or I would say in this case, the EU will try to regulate what it can in this case. It's not going to regulate your use of Bitcoin. You can use Bitcoin. Regulators haven't done anything for the last decade because it's decentralized and it's not tied to any federal currency or any type of derivative, right? But again, we're talking about a much broader perspective here. I believe in decent regulation, and I have no doubt that the EU is taking on pretty decent measures when you have countries like Germany allowing commercial banks to store cryptocurrencies, allowing people to start integrating these services, and startups in the crypto space to start integrating these kind of services into the broader economy in this case. So again, I'm interested to see how they come about approaching this. The ECB, with their talk of a central bank digital currency, is probably some of the more exciting talks alongside what's going on in China. But most importantly, above all, it's understanding the ramifications of this. Whether you believe in it or not, whether you would use it or not, it doesn't matter. It's likely going to be what's going to come about it when other people are using it. Okay? When these central bank digital currencies that will likely be labeled under the same currency names and the same valuations as the existing currencies, what is it going to mean when these systems get integrated? That's a very important thing to discuss. I think in China, more than anything, it's going to be a very interesting ramification. Basically, it's going to open up capital markets for a lot of money that's been stuck in China. to go elsewhere in the world and invest in different areas of the world. The Chinese government doesn't really care where it goes. They just want to make sure that they're able to track it and have control over that network. And if it's on, a relatively centralized or central bank run blockchain network, then they do have that control, unlike physical cash. So again, very important ramifications to keep in mind here. We'll have to see later on here with more details coming out here in regards to the study that came out here that talked about the European Union's efforts. Again, right now we're working with very kind of finite resources to understand this, but they're going to be hopefully filling in a lot of the gaps in the long term. Anyways, I want to go ahead now and dive over to taking a look at the current situation with COVID-19, traditional markets. I know, guys, it's probably getting a little bit redundant at this point. It's not something that at least we want to think about. I know it's almost like a fever dream we just wish would pass, but it's our modern reality. It's something we need to address, and it is having absolutely massive ramifications on the next 6 to 12 months when it comes to just about any market, the way that we live our lives, and the quality of living for everyday people as well as direct impact on people who are affected by COVID-19. Okay, so let's just go ahead and focus specifically on COVID. Good news is that as bad as of a response we had in the world to COVID-19, for example, with the misinformation from China, the lack of response or the delayed response from the Western world, from Europe to the United States, Canada, and Australia, at the end of the day, things are getting better. Case numbers on the logarithmic chart are starting to curve like they were in China back in February. This is really good. It's showing that social distancing, facial coverage, non-essential workers staying home, all of those policies are working quite well because it's not rocket science at the end of the day. These are things that are preventative measures to stop the spread. And along with that as well, we are entering into a warmer climate here over the next coming months, which is going to be difficult for the virus to survive in. Okay, so we have all these things coming in. It seems like in this case, the first wave is coming to an end. We can see here on the daily cases, globally across the world, they are declining. You look at the United States here, which again has been ramping up testing probably more than any other country in the sense of, a total basis. In this case, we're doing very well. And even on a per capita basis, we're doing quite well as well. We can see here, the curve is flattening, right? We just need to see a continuous drop here over the next coming days to really confirm it, but it looks like it's happening. Spain, already at the curve flattening back here in late March, and following through here, the cases are dropping significantly. This is wonderful to see. Italy, same exact scenario. Not as beneficial as Spain, but again, still seeing a decline in the curve here. Seems like things are getting better. France here, even though it had a significant amount of tests come here on April 4th, it looks like the numbers are declining. Germany as well, social distancing, working well. United Kingdom, probably one of the few oddballs out here continuing to grow. China, manipulated data, not the real numbers. But we know that China is taking pretty stark measures in this case to check for people's temperatures. Again, very draconian measures for the most part here to stay on top of the scenario. Iran, another one of the worst case scenarios, doing well. Turkey, a few other countries still expanding. So different countries are in different phases here. They're also at different levels of testing as well. So we won't get a full picture here on the global stage like we're getting in the United States, where we can dive into individual localities and certain cities and towns and actually get certain detailed information that we wouldn't get in other countries, right? But it's good to see in some of the larger countries we are declining these numbers. So the good news here, COVID-19, even with a second wave coming up that will come up here sometime in the fall, after the summer, is going to definitely be bad, but I think we're going to come very well prepared to it. I think we're going to play a lot of catch up, and we're going to come prepared for that second wave. Now, here's the thing we need to consider, that as much as we will come prepared for that second wave, we will likely not have a vaccine. So this means that we are going to have, again, more people probably staying home again, another second wave shock to the economy. And this also plays into the bigger concern here, and that's the longer-term psychological effects that this is going to have on businesses that are permanently shut, people who were willing to take investments they were willing to take beforehand, or make investments or risks that they were willing to make, and people who were pursuing certain dreams or career paths. Those are likely going to be stalled, or likely are never going to be fulfilled for a lot of people, and that is going to have such large of an impact. Oh, I can't believe I'm like messing up my words here. It's going to have such a massive set of ramifications for the global economy over the next coming months to the next few years, which is why I state that we are not only obviously clearly and at a minimum of a recession, but but we are likely stepping into a longer-term depression. Now, this might not be as long-term as what we saw in the Great Depression of the United States. Not everything is black and white, right? But I want to go ahead here and talk a little bit about the current existing scenario. So futures right now trading about down a percentage point here, right? We've already had a great rally in equities across the board, but there's a lot of things here that really come into play here, okay? So first off, I want to talk about treasury yields. This is, again, one of the biggest things that people are not talking about. Treasury yields have come up a little bit, but are still remaining very close to 0%, if not negative territory, in the vast majority of maturity yields in this case, or excuse me, maturity dates in this case for these treasuries. And the United States going into an area of negative interest rates, which has pressurized the Fed funds rate going near negative or at basically 25 basis points, a quarter of a percentage point, has forced treasury yields this low. And they will continue to go lower if the Fed has to lower interest rates at all. I have no doubt. I can tell you guys, if there's anything I'm confident about, it's likely that they're going either straight to zero, with cost of capital is zero, which will push treasury yields to negative territory again, as they already were, and the Treasury site did not mention that. They just left it at zero. But along with that, this is going to have a massive hindrance on savers, everyday workers who are likely have their money in a savings account already being depreciated by the massive QE programs that are being injected right now into financial markets. So there's a lot of those things. But I want to go ahead and just build a comparison here to talk about this psychological ramification. Again, we talked about some of those kind of real-world visual examples of how this is going to hinder the economy in the long term. And I want to go ahead and demonstrate here some similarities we can see between the Great Depression. Again, before we do this, I want to emphasize two things. If you're sticking with me, guys, then I want to take this time to explain it, because I don't want people to be upset and say, oh, you're making a false comparison. The key thing here to understand is, yes, the Depression, the reason for the Great Depression last time around, was very different from where we are now. There's some similarities of the excessive risk-taking that now is coming to roost. But again, we have a virus on our hands that has stunted economic growth and has really served as the catalyst. That was not prevalent in 1929. We had the Spanish flu, but that was in the earlier part of the 1900s, about a decade before the Roaring Twenties came to an end. And the second thing that I want to mention as well is that time frames are going to be a little bit different, because not only do they have different reasons for pulling back, but we also have different monetary policy tools. And this can lead to variations in performance as well. The Fed can stimulate markets in this case, where it probably didn't last time, back in the late 20s in this case. It took a very long time for there to be a rebound because we didn't have the economic response that we had this time around. But let's go ahead and just talk about it from the data, okay? I've rambled on enough. Let's get to the substance here. So what we'll notice here is, first off, the correction, the most severe sell-off we've ever seen in U.S. equity history. If we take a look from the absolute bottom, absolute top, a near 40% or 38.5% correction in a matter of about 6 weeks. Crazy stuff, guys. If you really take it from the next week here, that's slightly lower, it's 5 weeks in this case. Really, it doesn't matter. I like to be very precise here, take into account the peak to the bottom, 38% correction. And along with that, we've had about a 31.86% follow through from bottom to the current top here. Now, futures, of course, will open up a little bit lower, but again, this is generally what we've seen so far. Now, I want to go ahead and take a look at, and we're taking a look at the Dow Jones, right? One of the more respected top 3 indices for the United States. Let's go ahead and take a look here at what we saw in the Dow Jones back in 1929. So in 1929, we had a pullback from 380. Man, it's crazy to think. If you factor for inflation, the Dow Jones would be at a much higher valuation at this time period. But again, just it's crazy to think that the Dow Jones has grown so much over the century. We can see here, going from a valuation, a peak here of around 386.1, downward to here around 195, 196. Basically a clean-cut 50% pullback, 52% retracement back up. And then after that, a continued dwindle on for the next coming years. For over 2 years, equity valuations from their rebound peak continued to decline here and do an overall 90% haircut for equity valuations. That should not be green. That should be red. So, again, do I think that this is going to happen? No. And there's 2 reasons I believe that. that this is not going to be a 90% correction. First off, the Federal Reserve and the federal government are not going to wait off like they did during the Great Depression in their response. You need to understand a little bit of history to understand the political climate at the time. The president at the time, back in 1929, 1930, back in the early 30s, basically during the Great Depression, had decided not to respond as dramatically as many people had demanded at the time about, stimulating the economy. And there wasn't the kind of monetary policy tools or the knowledge at the time on how to respond to it, and what those the economic ramifications would be for us kind of injecting that amount of money like we do nowadays, or lowering interest rates that low, right? The only similarity is I'd say that interest rates are actually quite close to the valuations or the ranges that they're at right now. And we can take into account here, right, that because of that those monetary policy tools and the environment being a little bit different than the Great Depression, in this case, we're probably going to see something much more conservative in the sense of a pullback. And I think what we're likely going to see here is we're going to have, from top to bottom, a 50% correction on the Dow Jones Industrial Average and the S&P 500. Now, where does this lead you? It leads you down here between a very important support range, right? We saw it tested multiple times back in 2016, and the highs of 2007. Back here around 14,000 and 16,000, which puts you at 15,000 after the Dow Jones nearly topped out at around the big even of 30,000 points. This to me seems like a very rational way where valuations could go for equities. I'd like to hear what you guys think about it. Again, the time frame for this, who really knows? We don't know what the markets are going to look like, but I can tell you, no matter what, I have no doubt that this is basically a rebound to the short-term stimulus that the Fed has injected into financial markets. The relief that they've provided in the short term that has inflowed cash into equity markets. And along with that, insider buyers from a lot of these CEOs and individuals who work in the boards of these companies who have every incentive for these equity valuations to continue charging forward, right? But we've already talked again about the weakening environment of corporate earnings, and therefore that is going to lead in a decline of the two things that have propped up stocks: stock buybacks and dividends. And these are going to be massive lacks of inflows on markets. The lack of inflows from this entry point for buy-side activity into equity markets is going to have a longer-term ramification. And when the Fed stimulus isn't enough, it's going to start rolling back over again. I don't know when that's going to be. Again, we have to give it time. But that's my general thesis of what I'm quite confident is going to happen, at least taking a look at history here and understanding how markets rebounded and eventually afterwards continued onward. Oh, sorry, my apologies. I was looking at that at a different time frame. However, a course of a couple of weeks, we had a rebound in equities, a nice 52% rebound, and a continuation from a recession into a depression. So very important to take into mind. And just getting real here, guys, this is something that I want to hit home here. The severe amount of unemployment claims that we are seeing right now over the last 3 weeks is absolutely breathtaking. These numbers you're seeing here are individual weeks. This means that in this week alone, over 6 million people in this case filing for unemployment. Really, over the last week in this case, I think the most recent number was 6.6 million. Right? Now, again, when you see a decline in these numbers here, this doesn't mean that unemployment claims are going down. This means that we just had slightly less slightly less than we did last week, right? So millions of people every single week this is going on are filing unemployment. They're either being laid off or they're being temporarily furloughed, put on hold, in this case until operations reopen. And if you want to see this in the total number, right, total jobless claims, we only need to look here, the actual individual chart. This hasn't been updated here with the new numbers. That's the scary thing. This is continuing jobless claims. So the first week here, this is the week that ended March 28th, had already surpassed 2008 or any number we ever had recorded in history. This is basically double of what we're seeing now in the chart. So imagine that factored in here. There's some videos online that showcase just how significant this number is right now and how different it is from anything we've seen in history. But I want to go ahead and talk about, again, what ramification this is going to have on unemployment. We haven't even seen the real unemployment numbers. It's 4.4% for March. This number is going to spike up towards levels we've seen at a minimum here in 2008 and higher. And the thing that a lot of people are going to bring up here is, I know that people are going to say, Nick, but that's the short-term number. This is going to have a V-shaped rebound. We're going to see unemployment drop just as starkly. And yes, it's not going to take this long for unemployment to start declining, right? It's not going to be multiple months here. We're going to see a pretty stark decline in it. But it is going to be that the bulk of that increase is going to take a much longer period of time. And that has to do with the sheer fact that a lot of these companies are not coming back, guys. The ramifications of this are permanent. It is changing society, some ways for the better in the sense of the social changes it's going to have, and it's also going to be very negative on the economic ramifications, the employment ramifications for everyday Americans, the wages of every Americans, the standard of living. I mean, it is going to have ways of changing our life that we can't even predict right now. So let's go ahead here and actually talk about some key takeaways from this video. The first thing to understand here for the next coming months, the next year or two, is that COVID-19 will forever change the way that we live our lives, probably including your own. And the important thing to take away from that is that there can be some positives. There's going to be a lot more remote work. And then along with that as well, we're going to see new types of services and opportunities arise. But it's also going to mean that we're going to have to take some very precautionary measures. Again, good news in this case, that a lot of people are going to start wearing masks during this time of year when flu and other types of airborne illnesses are prevalent. This is really good news, and I think it's going to become a social norm to wear masks and be cautious for your neighbors, not just yourself, and to keep social distancing during this time of year, and to make sure that we have measures where we sanitize and to understand the importance of this in day-to-day life, where we've tended to either forget it or really never fully appreciate the importance of sanitization and making sure that we take precautionary measures during these times. So those are some of the positive changes. And there will be all types of opportunities and all types of ways where you can play a role in changing and shaping that future that can save a lot of lives post-COVID-19. Second, the economic ramifications are going to be immeasurable. And it's not going to be through the economic numbers you see now. It is going to be through the delayed continuation of those numbers remaining prevalent, as the global economic environment will not turn positive for a very long period of time. Even as things start to come in, as you'll start to see numbers such as GDP make a rebound, it's going to be a matter of whether or not that GDP rebound is significant enough and the global environment has made a proper response to COVID-19. The sooner we do that, the more confident we can be. Quite frankly, with the vaccine a year and a half out and the second wave coming, I don't see that coming in. I think that there's going to be another period of time where we have to self-isolate, not essential, and it's going to put people in a position where they're not going to be willing to take the risks that they would have taken beforehand. Again, the longer-term psychological ramification is the key second point to keep in mind. And the third one here is our economic response, not just in the United States, but abroad throughout a variety of global central banks. But I want to focus in on the United States and talk about the Federal Reserve, because I gotta say, it was beautiful this past week. I really saw it throughout Twitter here, that people rallied around Chamath here, who's a very well-known, he's kind of an ethical-based venture capitalist in this case. He runs Social Capital. And Chamath came on a variety of podcasts. He talked on Anthony Pompliano's podcast, a lot of awesome, great content creators. He's been going on the rounds here. But he came into CNBC, and he got confronted by one of the CNBC reporters, very kind of stark response of, he's basically taking this position of saying that companies should be able to be basically go bankrupt in this case. And he was having this response here to Chamath. He's like, how could you say such a thing? How could you want to let these companies, basically go under? And I think what best summarizes it here is not only the points that Chamath made in this case, that In the end, bankruptcies actually benefit the employees in this case because they end up owning a lot of the companies, that the CEOs and the toxic board members who make up these companies, who abandoned everyday people and workers for a long period of time and put the interest of shareholders above everything, that likely they need to be flushed out. But I think the best way to summarize this is how the Fed responded. Just this past week, after already announcing $4 trillion of operations, the biggest quantitative easing we've ever seen in history for the Fed, even inflation adjusted, we now have the Fed announcing $2.3 trillion of operations. A large chunk of that being junk bonds. The Fed has now basically said to all of the hedge funds, to all of the companies out there who took excessive risk buying up bad debt that they knew could not likely be paid back or that had a high chance of default during a recession, that they said, no worries, we'll cover you. Go make the same risks you did before. Here's some cash. Don't do it again. There's the old statement of fool me once, shame on you. Fool me twice, shame on me. If this balance sheet doesn't prove to you that the Federal Reserve's response is not working in the interest of everyday people and is rather working in the interest of corporations and financial conglomerates, the massive banking partners of the world, the major hedge funds that dominate the financial sector, I don't know what else can tell you that, guys. But I believe that you all see this just like I do, just how insane this is. None of this money here, bear in mind, none of this money is going to everyday Americans. Period. The Fed is not acting as a direct lender. It can get money over to hedge funds overnight like that and trade all those toxic assets just like it did for mortgage-backed securities. But for some godforsaken reason, while Americans are waiting to get a paycheck in their damn bank account, for God's sake, the Fed can't do something like that for everyday Americans. It can't just inject $1,200, $2,000, $3,000 into every American's bank account. How ridiculous is that? I mean, this is just insulting. And quite frankly, congrats to Chamath for the publicity he's gotten for this, because we needed to hear this from someone. Why are we bailing these guys out? They used all of the money they made over the last couple of years, which they could have put aside for a rainy day fund, that they could have put aside for better wages for employees, that they could have put into research and development, and instead they kept their businesses relatively stagnant. They didn't invest in research and development. They laid off people en masse as they continued to conglomerize and acquire other companies and liquidate the assets. And along with that as well, through all of that, continued to take every dime that they made throughout the process and inject it into stock buybacks, inject it into dividends. They continued to enrich and prop up an artificial bubble in equities. Shame on them. Let them get kicked out of the company. Let their stocks go to pennies on the dollar, because quite frankly, they took the risk. They're accredited investors after all. They know that they're taking that risk. They have the ability under current legal definition to do all those things because they're supposedly sophisticated enough to be able to take on that risk themselves. So let them go bankrupt. The airlines are not going to shut down. The restaurants, the massive corporations that exist in today's world are not going to shut down en masse. They will come back in time because there is a population that demands those products and services. What doesn't need to persist is our continued arrogance of thinking that tossing money at certain financial players is somehow going to help the underlying economy. All it does is it stimulates artificial equity bubbles that are going to come back even harsher when reality sets in that it's not a permanent solution to a pandemic. Anyways, I rambled on a little bit today, guys. I know this has probably been a little bit of a lengthy video, but if you liked it, definitely drop a like. Always appreciate it. And if you guys are new to the channel, consider subscribing, hitting the bell icon, and join the Data Dash family. It's always appreciated. I'd like to hear from what you guys have to say, because I surely know with the lack of breath that I have that I've talked enough today. But if you guys have something to say on this, whether you agree or disagree with me, leave it down in the comments down below. I'd like to hear from you guys, get some perspective from you. You might have more of an optimistic view. You might have even more of a bearish view than I do. But I would like to hear from you guys. I think that this is easily setting us up for a 50% pullback. And the reason I call it a depression in this case, even though that's generally the level we see with the recession, is I feel this is going to be drawn out over a longer period of time and have ramifications for generations to come. And that's, I believe, a relatively conservative view, just looking at the facts. But again, you guys will have to make your own judgments and take my opinion as nothing more than that, just an opinion. And I hope you all have a fantastic day wherever you are. But until the next video, I'll see you all in the next one. Stay tuned.